Good morning and welcome to day 2 of managerial accounting. Today we are going to actually start talking about accounting stuff. So we'll be starting with chapter 15, the introduction to managerial accounting. Some of what you see in this chapter, if we look at the objectives, some of what you see here in the chapter, I already hit on Tuesday. So objective 1, for example, I really talked about or said what I needed to say about that, reminding you of the difference between financial and managerial accounting, including who's using it and how it's structured. So we know that managerial accounting is going to be much more flexible, much more prospective or forward-looking, helping decision makers within the company make decisions. Certainly you should read what the book has to say about that, but I just summed it up for you in about 2 sentences. If you have questions, of course, if you have questions on what you read, even if it's not something we hit on in class, you certainly should be asking if you have those questions. I just don't like to take up a whole bunch of class time talking about what you should also be reading in the book. So for today, we're going to start with what does it mean to be a manufacturing company? How does that look different in the accounting records? And we'll be looking at some of the materials that are in the reference folder for this chapter. So reminder, in the reference materials area in Blackboard, you'll want to be referring to that chapter 15 folder because it does have several items in there, most of which we'll talk about during class, maybe all of it, but they're there so that you have them for reference for later. And then we will be looking at, so how does it look different on the financial statements, and talking about, as we frequently do, we'll mention, so what does this mean also for service companies? With that said, I want to skip ahead. I think. There we go. I'm going to skip ahead to learning objective 2 and talk about what does it mean to be a manufacturing company and how does that change what we do in our accounting records. So I don't mean to suggest that anything that we talked about in financial accounting is no longer true, but there are some things that we add a new layer to the complexity of what we're doing, because in financial accounting, if you recall, we had an entire chapter 6, on inventories, and we spent most of that chapter talking about the flow of goods and the flow of costs and the different inventory valuation methods, that is LIFO, FIFO, average cost, specific identification. Those might ring a bell with you. We talked about perpetual versus periodic inventory systems, and which just refers to how often their inventory records are being updated. The concept of perpetual versus periodic still applies for a manufacturing company. To a certain extent, those concepts of LIFO, FIFO, average cost also still apply. But again, we're adding a new layer of complexity because these companies, if you're manufacturing the product, that means you are making it. You start with raw materials and you do something to them to turn them into the finished product. And so when we're a merchandising company, even though we still have to decide whether we're going to use perpetual periodic system, LIFO, FIFO, average cost, method for valuing our inventory, we still have an invoice from our supplier that says, here's how much that product cost when you bought it. When we make the product, nobody's handing us an invoice, and we have to figure out what that product cost to produce. Then we can decide how often do we update our inventory records, and do we say we sold the oldest stuff or the newest stuff first, or do we average it all together? So again, those concepts still apply, but we're adding more to it. So just in case you are not really buying what I'm trying to sell you, you can see visually, we start with materials. So these materials are things that we buy from our outside suppliers. So we do know how much those materials cost. But then we do some work, and in this case, it's cutting and assembly. We do some work to turn those materials, those raw materials, into a finished product, which is then available for sale to our customers. In a perfect business world, it might be that we only make the product because someone has ordered it. We call that pull-through production. I will write that on the screen. And you'll hear more about that later in the semester. So pull-through production means that we are producing the product because we have someone who wants to buy it. Push-through production, on the other hand, means we produce the product because we have a machine that's open and we can. We have time and we have the materials and the availability of machinery and workers. And so we're making it because what else are we going to do? That's our job. We're a manufacturer making this product. But we don't necessarily make it because we already have a customer lined up. We hope someone's going to buy it, but we don't have that customer already lined up. And that's a little bit different from a management perspective. So as we are calculating the cost of producing a product, we are going to be including what I refer to as the product component costs. So there are 3 product component costs. All products that are manufactured are going to include all 3 of these costs, and they are direct materials, direct labor, and manufacturing overhead. Direct materials, direct labor, and manufacturing overhead. So the first 2 costs are direct costs, which means they can be traced directly, easily, conveniently, economically to a specific product or batch of products. So if you think back to that diagram we just had up of them making the guitar, we know that you have the body of the guitar and you have the strings and you have the fretboard and you have the adjusting pegs, I don't know what they're called. And we know that those are the direct materials. Every guitar is going to have a front and a back and sides and the fret and all the other things that go into it. We can trace them directly to a specific guitar if it's custom made, or if we're producing them in by the hundreds, we can trace those costs to a batch of guitars. I usually use bicycles as an example. And when you're making bicycles, you know that every one of them is going to have 2 tires and everyone is going to have 2 pedals and 1 handlebar, unless it's a tandem. Don't have me go in there. Direct labor is also clearly a direct cost. And this is the labor that our workers are employing to produce that product. And we know that that worker was working on that guitar, that bicycle, or he was working on that batch of guitars that were made today. So we can trace it directly to that specific product. He was working on the guitar, not that guitar. Manufacturing overhead, as it kind of sounds, is really a catch-all that includes everything else. So this is the traditional approach to accounting for a product cost. As we move into the next few chapters, we will talk about a more up-to-date method of looking at that overhead. But the traditional approach includes these 3 components. The first 2 can be traced directly, easily, conveniently, economically to a specific product or batch of products. And the manufacturing overhead is all the other costs associated with manufacturing. I like to think of it as if you weren't making the product, you wouldn't have these costs. So what does that include? Well, it includes things like the cost of the factory and the machinery and the people who are supervising the workers. So if you're a supervisor, you may not be directly hands-on working on a product where we would call that direct labor, but if we didn't have a factory, making product, we wouldn't need a supervisor for the factory. We wouldn't need a plant manager for the factory. The machinery, the utilities, you know, electricity, and I don't know what else they might have, telephone, maybe they have gas for heating or for running some of their equipment or something, insurance and property taxes on that factory. So we're separating out the costs that are directly related to manufacturing, even if we can't trace them to a specific product. That goes in this catch-all account called manufacturing overhead. And you'll hear more about that as we keep moving. Any questions at this point? So every product that we're costing is going to include those three costs. Every single product, all the time. There's no way to avoid any one of those three costs. So I already really described direct and indirect costs. In Blackboard, one of the items in that reference materials folder, let me just go back to that. One of the items in that reference materials folder, right here. So I didn't create the flowchart part. I snipped that from a textbook that I used to use, no longer use for this class. But I added the excuse me, the words underneath. Clearly I did it in Word and it thought that inventoriable was not a word, and I didn't notice that before I put it on my diagram. But I was so proud of my color coding that I am hesitant to change anything about this. When we talk about costs, all costs can be separated based on some quality. And so the one that we just were looking at was this idea of whether the costs are traceable to a product. So these costs, this separation or classification applies only to product costs. If we go over here to the far right, you can see that all costs can be divided into either product or period costs. So product costs are ones that we don't put on the income statement, we don't expense until we sell the product. That's where that term inventoriable comes from. It means it belongs on the balance sheet as an inventory asset for us until we actually sell it. Then it becomes part of cost of goods sold. Period costs are the costs that are expensed in the period, in the month or quarter or year in which they are incurred. These include things like selling, general and administrative expenses. Cost traceability refers only to the product costs. As we continue through these first few chapters, we'll be encountering this one, dividing costs based on their behavior. You know, it sounds funny to think that costs behave, but it refers to what makes those costs increase or decrease. We'll come back to that. The one that we will spend the least time on, and is also the one that's the fuzziest concept, is whether a cost is value adding. So this is from the customer's perspective. Is this something that makes our customers want to pay more for our product or be willing to pay more for our product? Does it make them willing to buy our product instead of someone else's? Does it make them willing to buy more of our product than they would if it didn't have this cost? So that's a little bit fuzzier. That's where these four different cost classifications, that's the one that I am most likely to have a disagreement, and you may disagree with me. I may disagree with what the textbook says. The other three are fairly straightforward and pretty cut and dry. Either they are or they're not product or period costs. Excuse me. Okay. So this chart is here, and for reference, if you need it. And we will be exploring each one of these four ways of classifying costs throughout the course. Anything else I want to show? No, so that's all I need to show you from there for now. So let's pick up here. So we know the three cost, product component costs, direct materials, and I've given you some examples already. If you are making a guitar, all the pieces that go into it. Now when you are making a guitar, there's also probably some materials that are used that you may not trace directly to a specific guitar or batch of guitars. Things like glue. So you may be using a very finely calibrated tool to apply the glue to stick the pieces together. However, you are probably not then reporting 4 cents worth of glue went to guitar A and 4.5 cents worth of glue went to guitar B. So the term that I used, or the phrasing that I used, was easily, conveniently, economically. So we always have to keep in mind, does it even make sense for us to try to trace 4 cents worth of glue to a specific guitar? Then I would argue no. That question of materiality in accounting, is it big enough to matter? And so there are some materials that we use that are indirect materials, things like glue and nails and things that it just doesn't really, if you're making that bicycle, the lubrication that you might put on the wheels, the brakes, the chain, or whatever. Those are things that we might be really careful putting it on, but we're probably not recording those costs separately because it just doesn't make sense. It doesn't, it's not material. It's not a large enough cost to matter. So those indirect costs, like the glue and nails, become part of the manufacturing overhead. As you know, that becomes part of the cost of the product, but it takes an indirect route to get there. And we'll see that before the end of class today. We already explained what direct labor would be. An individual or our employees who are hands-on working on the manufacturing of that product. And so we know your time was assigned to this particular product or batch of products. If you have any exposure to the manufacturing environment, you are probably already familiar with this because normally you are assigning your time to a specific job. It's fairly high tech in some places now too, that you are actually, you have a scanner and you're scanning the barcode for that job so that your time is appropriately allocated. You may work on multiple jobs during the day, and it's important that your time is charged to the correct job. Part of your time might be spent not working on a specific job, and that would become indirect labor. So while you're cleaning up around your machine or doing some routine maintenance and upkeep on your machine, that would not go to a specific job, and so that would be indirect labor and become part of the manufacturing overhead. And I think I mentioned most of those already, some examples here of factory overhead costs: heating, lighting, depreciation, any facility level cost. You also know that I like to give you different words for the same concept so that you're familiar with what that means if you hear them in another, outside of this classroom. So you can see a couple other examples there. Factory overhead or factory burden are other very common terms for what I tend to refer to as manufacturing overhead. Or in a generic sense, you might hear me just call it overhead. In chapter 17, these two terms will come back up, in particular the term conversion cost we will be using. The terms prime cost refers to the direct costs, so direct materials and direct labor. Conversion cost refers to direct labor and overhead combined. So you're never going to hear someone say, well, what's the total of the prime cost and the conversion cost, because you'd be double counting the direct labor part. But in chapter 17, when we talk about process costing, is where you will hear that term conversion cost will be much more relevant for us at that time. So Okay. We already talked about product costs versus period costs. Because I haven't said it yet this semester, I should remind you that you do have access to the student version of these PowerPoints as well. So if you are, if you like the way things are arranged, it's kind of an outline of what's in the book. You do have access to those from the student, what's it called, companion website. I'm not positive that link is in Blackboard yet, but I'm making a note. I'll make sure it gets there later today. It will be, if it's not already there, it will be in the Cengage content folder. I will put the link there for the student version of the PowerPoint, in case you find this helpful. Okay. So I want to talk next about what makes our financial statements, specifically the accounts on our balance sheet, what makes them look different? How could we tell, if we could see enough detail on a company's financial statements, how could we tell that a company is a manufacturing company rather than a merchandising company? And it all comes down to the way their inventory is reported. So in financial accounting, when we talked about inventory, we were talking about merchandise inventory. It was the product that we had purchased from our suppliers and had available for sale to our customers. And those merchandising companies had just one inventory account where they put all their inventory. Well, on a manufacturing company's financial statements, you will not see just one, if you could see the detail. When you look at, if you chose a manufacturing company, or you will choose a manufacturing company for your project this semester, when you look at their condensed financial statements, you're just probably going to see one line for inventory. But if you could see enough detail, if you could drill down into that balance sheet, you would see a minimum of 3 different inventory accounts for a manufacturing company. So, sorry, let me just get ahead here. And so you can see on the screen right now what those 3 inventory accounts, the 3 separate inventory accounts would be typically called. And in a minute, I'm going to go back to Blackboard and show you something, go through something that's in that folder. I apologize in advance for the lack of professional quality to what I'm going to show you. It is literally a picture that I took of a whiteboard in my classroom back when students used to be mostly in the classroom and I could use the whiteboard. Now I need to stay in front of the camera. I have tried, but it's just not visible on Zoom if I try to use the whiteboard. So I now am stuck with writing on the screen, which works fine. But I don't have the knowledge, I don't have the access, I guess, to a computer program that will help me easily draw the flow chart that I have drawn on the board. So you're stuck with seeing a picture of what I would draw on the board. I apologize in advance that it looks kind of scribbly. The 3 different types of inventory accounts are on the screen right now. Materials, these are the raw materials. These are the parts or pieces of the product that we buy from our supplier. When we buy them from our supplier, we add them to the materials inventory account. And then when the shop floor, our manufacturing folks, when they need some of it, they send a request over to the warehouse and say, hey, we need some more of that ABC stuff. And so a person in the warehouse gets it off the shelf and takes it out to the shop floor. And in our accounting records, we move the cost of those materials from the materials inventory into work in process. So work in process, also known as WIP, W-I-P. So you'll see me abbreviate that. That's the extremely common abbreviation for work in process inventory is WIP, W-I-P. And so WIP is the dollar amount, the dollar value of the stuff that's in process right now, that's literally in the, on the shop floor being made into the product. I just explained how the materials get in there. We're also adding into that account the direct labor that's being applied to turn those materials into the product. And we'll talk about in the next chapter, the manufacturing overhead also gets applied into that account, which is a little bit separate process. Remember, we said it's kind of a two-step process. All those costs go into the overhead account, and then they get to the product. So in the next chapter, in chapter 16, we'll see exactly how that happens on the traditional approach. And then finally, all that stuff that we're working on making into a product for our customers, when we are done with it, it's no longer in process. It's no longer on the shop floor. It's been moved into maybe the shipping area or out into our store, depending on the setup that we have. And it's available for sale to our customers. At that time, it becomes part of finished goods inventory. And that's the account that's analogous to the inventory account for a merchandising company. It's stuff that's available for sale but has not yet been sold. Just like for a merchandising company, once we sell it, we have to take it off the balance sheet. We don't still have it, and it becomes part of cost of goods sold. Let me go to my very professional looking flow chart here. One second. So this flow chart, as I said, is a photo that I took of a drawing that I had on the board. At the time that I drew it, I was not expecting it to be published like it currently is. And also there's a note at the bottom to just point out, you can ignore the dollar amounts. These dollar amounts actually came from an exercise that I used to do from the old accounting textbook that I no longer use. The drawing is still relevant since I haven't come up with a better way of drawing this so that it looks a little more professional. It's what we're stuck with. It will still make sense. So let's just walk through what this looks like, and I would refer to this as the flow of costs through the inventory records. So again, as I said at the very beginning of class, in financial accounting, when we talked about the flow of costs, it was a much shorter process. We bought them from our supplier, we put them in the inventory account, then we sold them and we moved them out of the inventory account into cost of goods sold. We still had to decide which ones did we sell, and that's the question of LIFO, FIFO, average cost, specific identification. That's the flow of costs through our inventory records. Same concepts still apply, but we've added the complicating factor that we're actually making this product. We have the 3 different inventory accounts. When we get to the process costing chapter in a couple weeks, we will talk more about this work in process account because, as I said, all manufacturing companies have these 3 types of accounts. For many companies that use a process costing approach, they have these same 3 types, but they probably have more than one work in process account. So in the next chapter, we'll be talking about job order costing, which is one approach. And in job order costing, those companies have just one work in process account. They have one each of these 3 types of inventory accounts. But for process costing companies, they probably have more than one work in process account. Okay, so same 3 types.
So a lot of the 3 inventories can kind of be summed up on where it's at. So like the materials would be receiving, the work in progress would be like in the factory itself, and then the finished products would be like shipping.
Mm-hmm. Yeah, that's a good way of thinking of it. So The materials are probably sitting in the warehouse, and the work in process is on the shop floor, and the finished goods are in the store or in the shipping area waiting to be sent out when they're purchased. Yep, good way of thinking about it. So let's just follow through what's happening here. And I will ignore the dollar amounts and just talk in general terms. So when we buy stuff from our supplier, someone has issued a requisition. We issued a purchase order to the supplier, and the product arrives to us. In a later chapter, later on in the semester, we'll be talking about the concept of just-in-time inventory and lean manufacturing. And so that refers to the timing of the arrival of those raw materials. And we want to keep at a minimum the amount sitting in that account, because we already had to pay for it. It's sitting around, it might go bad, it might get lost, it might get damaged. At a minimum, it impacts our cash flow. And so we like to keep the amount of materials we have sitting in the warehouse at a minimum. We have to pay someone to watch it. Maybe we have a guard stationed there. We have someone who's moving it around. We may need a forklift and all the rest of that. So probably want to keep our materials inventory to a minimum. When we are doing the calculations that we will be doing then, think about what's happening in this materials inventory. We probably at the beginning of the accounting period, unless we're a brand new company or we're really perfect at just-in-time inventory management, we probably have a beginning balance. Then we add some stuff to it when we buy more stuff. We subtract some stuff from it because the folks out on the shop floor asked us, hey, could we get some more of ABC? And so we moved some stuff out of inventory into work in process. And then we have an ending balance. So some of the exercises that we'll be looking at in this chapter to reinforce what we're discussing here will have us be using that flow, beginning plus purchases minus requests equals ending balance, to solve for the missing piece. So we might be given 3 of those amounts and have to find the 4th. To help you with that, let me show you. There is another page that I have put in Blackboard for you called Basic Calculations for a Manufacturing Firm. And this is what I just described. Beginning materials plus purchases gives us materials available for use, minus ending materials gives us direct materials used. So if you know 3 of those 4 numbers, you should be able to solve for the 4th. You can rearrange that equation, and we will be coming back to that. Let's go back to our flow chart. You'll notice that there are indirect materials here. That's the nails and glue that I already mentioned. And so these indirect materials, when those are requested for production, we move the cost of those materials out of materials. They went to the shop floor, but they become part of manufacturing overhead. Let's move on then to, stop me if you have any questions. As always, you do not need to wait. For those of you who are on Zoom, if you use the raise my hand function, if you're concerned about interrupting me, you shouldn't be. But if you are concerned about interrupting, you can use the raise my hand function, and that actually pops a note up on my screen that says, Joe raised his hand, and then I will know that you're waiting to ask a question. You guys who are in the classroom, I can see you, so I can see if you're about to, I can tell if you're about to ask a question. So please feel free to interrupt me if you do have questions. So looking then at the work in process. So again, we probably have a beginning balance. We probably had some stuff we were still working on. Just because the last month ended didn't mean that the shop floor was empty. So we had some stuff already in process. This beginning balance includes all 3 product component costs: direct materials, direct labor, and overhead. During the month, we added some direct materials because the requests were sent to the warehouse. Hey, could you send us some more of that stuff? We're running out. So we physically move the material onto the shop floor, and in our accounting records, we move it out of materials inventory into work in process. We also have some people who are performing direct labor, who are working on making the product, who are actually gluing and nailing and sanding and cutting and all the rest of the stuff that has to happen. So those costs get added to work in process directly from payroll as we pay our workers. Remember, I said we're probably keeping track on their timesheets through the use of barcodes or whatever. Which job was that employee working on? How do we allocate their time? You'll notice there's also some indirect labor. So that's the cleaning up, the maintenance on the machines, the time that's not spent on a specific job from our direct labor. It also includes the supervisor and the plant manager and the scheduling people and anyone who's working on the manufacturing side of the house, but not hands-on making the product. So all of those costs, and as you can see from this arrow, all of those costs get added into our manufacturing overhead account. You can see a list of mostly the things that we already talked about that are also considered overhead. This would be the utilities on the manufacturing plant only. It wouldn't be the utilities for the office. If we have one utility bill, we have to have some way of dividing that up. The part that's the product cost for the manufacturing and the part that's the period cost. So we don't have two separate meters. We don't have two separate bills. We have to divide that up somehow. And same thing, of course, for property taxes and insurance. If it's one amount, we'd have to have a way of dividing that because part of it is a product cost and belongs here. And part of it would be a period cost, the part that's for the office. Okay, so beginning balance, we added direct materials, we added direct labor. You'll notice this dotted line here that I'm pointing at right now is the overhead allocation. That happens, we already have that two-step process. They go to hang out in the cost pool for manufacturing overhead for a little while until we allocate it to the product. In chapter 16, we will see how that overhead allocation is done under the traditional approach. And then later on, we'll talk about other ways of allocating that overhead as well. But for now, you just need to recognize it's a two-step process. It doesn't go directly to the product. It makes this interim stop and the overhead cost pool. And then there's a process that we follow to allocate or assign those costs to the product. So now beginning balance, we've added the 3 product component costs. We hope that some of that product we actually finished and moved out and hopefully sold some of it at least. This arrow right here, the amount that we finished and moved out of work in process into finished goods, we have a unique calculation for that, and it is the cost of goods manufactured, or COGM. In our, somewhere here, there we go. In the folder for chapter 15, I have included an exhibit. Again, I just snipped this from the textbook. It's exhibit 14 from this chapter. So you can see what the cost of goods manufactured calculation looks like. Now it looks like a financial statement, but it's not a financial statement. We learned in financial accounting, I reviewed with you on Tuesday, the 4 financial statements, and this was not one of them. So income statement, stockholders' equity, balance sheet, and cash flow are the 4 financial statements that have to be shared with the public and audited and so on. This cost of goods manufactured is a report that's needed to prepare the financial statements. You'll notice the bottom line here is cost of goods manufactured. Then if I scroll up a little bit, you can see on the income statement that cost of goods manufactured becomes part of the calculation for cost of goods sold. So we will be looking at an exercise where we do our own statement of the cost of goods manufactured. But I wanted to point out, this is not a financial statement. The information that's on this form, this report, is managerial accounting. It's internal. This is probably not shared with the general public. Okay? It's not required that we share this. The cost of goods sold shows up on the income statement. But what the breakout is in the cost of goods manufactured is probably considered proprietary or private, not for public display. So I have that in there as well because you may find that useful, and we'll be referring to it as we work on some of the exercises, because being able to see what the basic format is will help us with those exercises. So it's in there, but it's just a snip from the book. It's exactly from the book. Okay, so now we have the finished goods. We know how they got there. We know it includes all three component costs. We know there's probably a beginning balance. We add something to it, that's the cost of goods manufactured. We sell some of it, that's the cost of goods sold, and then we have our ending balance. As we sell it, we move it off the balance sheet. So these three accounts are all on the balance sheet. These accounts over here on the right are not on the balance sheet. Payroll and manufacturing overhead are cost accounts. They don't appear on any of our financial statements. Income statement, obviously a whole separate financial statement. Last thing I want to show you here is in that basic calculations worksheet or formula that I have up there, you've got two more formulas. One to find cost of goods manufactured, and then one to find cost of goods sold. So again, you will find those general formulas helpful and useful as we work through our assignments for this chapter. Let's go to our exercises. So this is the chapter 15 exercises in Cengage See Now. As is the case for every chapter, there are 10 exercises. And as with every chapter, we will do most of them together. Occasionally, though, there are ones like the one that's on the screen right now that I don't find particularly useful for us to do them together. So every exercise we will talk about in class, and we might do a little bit of it together. In most chapters, we will do all the exercises together. But this exercise, and there are a couple more in this chapter as we learn the new concepts, this exercise is really a multiple choice exercise. So I know those of you who had me for financial are already aware of this, but I'm really saying this for the benefit of people who did not have me for financial and so haven't maybe used this particular website before. So what we're asked to do for this exercise is indicate whether the following costs for Procter & Gamble, a maker of consumer products, would be classified as direct materials, direct labor, or factory overhead. We're going to do a couple of these together, but I wanted to show you, just so you're aware of how this works, if you've never used this before. I wanted to show you one of the tools that you have available for you. So letter A says depreciation on assembly line equipment. So which of those is that? Is it direct materials, direct labor, or overhead? It is overhead. So if I just choose overhead, and if I were to click my work, or click check my work, it's going to tell me green check mark, yes, that's the correct answer. You'll notice when you click the check my work, it also pops up some grade boxes that usually give you some additional information or helpful feedback to find the correct answer. So I am totally aware that I could just do this, or you could just do this if I asked you to do this one on your own. Check my work. Okay, well, the red X's are wrong, so now I'm going to try the next one down on the list. So if I just did this, it would take me about 13 seconds. Okay, so got some red X's there. Okay, so it didn't take me long at all to get all the green check marks there. If I look down in the bottom left-hand corner, I can see the assignment score is 10%. There are 10 exercises. Each one is worth 10% of the grade. And so with little or no effort on my part, I just got all the correct answers and I get full credit for this. And, you know, I didn't even read almost the entire exercise. And I understand you can do that. I strongly discourage you from doing that though, because, you know, that doesn't help you learn any of this. So please use the Check My Work as it's intended, as a helpful tool. Try them on your own first. And if you get stuck, use the Check My Work to help point out your errors. I think that's pretty clear. So if you haven't already done this one while I was playing around with the X's and checks, please try the rest of this on your own. And we're going to move on. We've talked about those 3 categories. You should be able to read those, however many 10 costs are listed there, and assign them to the correct product component cost. Point out one other thing, to show you one other thing here in Cengage, which is helpful. The words that are green, if you just hover your cursor over that green, it will pop up a definition. So what does that term mean? That may be helpful for you as well. Okay. Same thing for exercise 2. We talked about what's a product cost and what's a period cost. So we are not going to do all of these together, but I'll do a couple. So advertising expenses, that's not part of the product, so that must be a period cost. Fabric used during production becomes part of the cost of the product. Property taxes on the factory would be part of the cost of the product. It's an indirect cost, but it's still part of the cost of the product. Sales commissions would be a period cost. And so again, in the interest of time, I'm going to ask you to do the rest of those on your own. If you get stuck, you can use the Check My Work. Of course, if you have a question about any of them, you should ask. I'm happy to help. For exercise 3, again, these are all multiple choice. You're just going to be choosing the correct term from you read the sentence, choose the correct term from the parentheses. Most of these, if not all of them, are things that, most of them are things we've already talked about. All of them are things that are covered in the textbook. Do those on your own. If you have any questions on it, you can ask. Factory overhead costs combined with direct labor costs. So labor and overhead are the conversion costs. We talked about that one. This chapter, as you can tell, is a little bit more conceptual and a little bit less of the doing of accounting. So we, in case if you're new, this is not normally the case that we have so many that are things we don't completely go through together, that don't require a lot of thought or calculations and so on. Exercise 4, though, is also one of those kind of multiple choice. So an example of factory overhead is, and that would be the electricity, not the CEO's salary. That would be a period cost, not a product cost. So you should be able to go through these on your own as well. Again, I know you can get the correct answer without any thought, but if you're working on that and have questions, just ask. Almost done with the multiple choice kind of exercises here. Next exercise, a partial list of the costs for Wisconsin and Minnesota Railroad, a short hauler of freight, follows. Classify each cost as either indirect or direct. And so we are being told then that each one of these is part of the cost of the product or service that we are providing. And our job is to determine whether this would be a direct or indirect cost of the train as the cost object. So the cost to lease or rent the locomotives and rail cars, we can trace that directly to the service that we are providing, right? Information technology support staff salaries would clearly be an indirect cost. So again, you should be able to go through the rest of those and determine which are directly traceable to that, the train as the cost object, and which are indirect. Part of the cost of running the train, but hard to trace directly to a specific short haul in that case. Finally, we get to something that's actually doing accounting. Before we turn to this exercise though, are there any questions? Any questions about what we've talked about so far? Cost classifications, the flow of cost through the inventory records. We're going to be looking at the basic calculations here that I just showed you, the calculations here in Blackboard. Any questions? So let's look at this exercise. The following events took place for Sorensen Manufacturing Company during January, the first month of its operations as a producer of digital video monitors. So they're making this easy for us by making it the first month. How does that help? Because there are no beginning balances. If this is their first month, they start out with nothing. So what I'm going to do is put some T accounts on the screen here. I don't want that red, hang on. I'm going to put some T accounts on the screen so we can keep track of what's going on. You'll also want to keep in mind those formulas that I showed you in Blackboard, the basic calculations for a manufacturing company. All three on here. Okay. Whoops. So we're going to label those materials. And I'm just going to use abbreviation, work in process, and finished goods. And so they made it easy for us because they did not have beginning balances, because this is their first month of operations. And so let's see what we were told. We purchased $250,000 worth of materials. Now, keep in mind the rules from financial accounting, and I reviewed them just very briefly on Tuesday. Every transaction has at least two accounts, one that's going to be debited, one that's going to be credited. Excuse me, in the Blackboard reference materials at the top of that folder, not in any given chapter, you have the review for you of the fundamental accounting equation expanded, showing normal balances, and it also shows you how to write a journal entry and what's required for that. So keep in mind, as we go through these 9 events that took place with Sorensen in January, that I'm only tracking the part that affects these 3 accounts. Okay? So when I talk about purchasing of materials, we know that that affected at least 2 accounts, but I'm probably showing only one of them on here. Doesn't mean there wasn't another one. And I will probably each time ask you to think about which other account would be impacted. But as we're just starting out reviewing from financial accounting, remember that there has to be a debit and a credit, at least one for every transaction, and the dollar amounts have to be equal. So this is basic transaction analysis that we did in financial accounting in the first, starting in chapter 2 and 3. And we're bringing in now these new types of inventory accounts that we did not have in financial accounting. When we purchase $250,000 of materials, what happens in our accounting records? What are the two, or what's one of the two accounts that's going to be affected?
Would you debit materials inventory?
That is correct. So we're going to debit materials inventory, $250,000. These inventory accounts are all balance sheet accounts. They're current assets. And because they are assets, they have a normal debit balance. So to show that we have more materials because we just bought a bunch, we add them or debit them to the materials inventory. The credit side would be, well, how did we pay for it? It would either be to cash or to accounts payable. So we're not showing that, but because we're only looking at the inventory account, but it definitely happened. Next, we used $180,000 of direct materials in production. So when that happens, well, we no longer have them in the materials inventory account. To use what Drew said here in the classroom, if you want to think of it from a kind of geographic or positioning standpoint, we took the materials out of the warehouse and moved them onto the shop floor. So in our accounting records, we have to show that that happened. We moved them out of the materials inventory into work in process. So we do see both the debit and the credit here because they were both to those inventory accounts that we're tracking. Okay. What happened next? We incurred $450,000 worth of direct labor wages. So we know that all of the wages are going through the payroll account. So they're credited there to payroll or salaries, wages payable. And the question is, where does the debit side go? So for the direct labor, that goes to work in process. The next item says incurred $180,000 worth of factory overhead. So we're going to combine two steps into one here. We know, we saw, if I were to go back to that flow chart that's in Blackboard, that the manufacturing overhead makes a stop first in the manufacturing overhead account. And then we apply it to work in process. And so for the sake of this, this exercise, we are going to simply skip the middle step and we're going to apply the work in the overhead into work in process. There would be two steps involved with that. But we're combining it, condensing it. Okay. So at this point, I'm just going to turn on my calculator here. At this point then, 180,000 plus 450,000 plus 180,000. At this point, we have added a total of $810,000 into work in process. That includes all three product component costs: direct materials, direct labor, manufacturing overhead. Letter E tells us, yeah, but we aren't still working on all of that. We finished some of it. We finished $760,000 worth of that inventory. And when that happens, it moves out of work in process. It moves off the shop floor and moves into either the shipping area to wait to be shipped to customers, or maybe it moves out into our store, depending on how we run our business. So again, we're seeing both sides, the debit and credit side of that entry moves out of work in process and into finished goods. So since I have the number on my calculator right now, I'm just going to finish this up. So what's the balance in our work in process inventory at the end of the month? We added $810,000 worth of materials, direct labor, and overhead. $760,000 worth was moved out. So the ending balance would be $50,000. If you do not remember how to balance a T account, I will remind you. We add up all the debits. That's called the debit footing, the total of all the debits. We add up all the credits. That's called the credit footing. We subtract the smaller one from the larger one, the smaller footing from the larger footing, and we record the balance on the side that had the larger footing. So the dollar amount on the left or the debit side was larger than the credit side. So the difference between the two totals gets recorded on the debit side. We still have $50,000 worth of work in process inventory at the end of the month. Might as well do the materials inventory now. Go ahead and do that on your own. And then we can keep going. So we did through letter E. Let's letter F, sold goods for $1,200. Well, that's the revenues that we're going to report. So I'm going to leave that alone for a moment. So we charged our customers $1,200,000 for the product that we sold them. But in letter G, it tells us that product had a cost to us of $675,000. So as we saw on the flow chart, when we sell something, we no longer have it. So it's not sitting in our store. It's not sitting in shipping anymore. We need to remove it from our balance sheet as well. So it moves out of finished goods, credit finished goods, and it moves into cost of goods sold. I'm just going to balance this last account here, and you can go ahead and do that as well. So any questions about what we've done so far? Any question about really the flow of cost through those inventory records? Remember, you have the basic calculations here in Blackboard. Those will help you to put the pieces together, do the calculations by solving for the missing piece. We have two more pieces of information given to us in H and I. These are the period expenses, selling and administrative expense. And so now we can finish up our exercise. We already have the answers to part B. $70,000 left in materials, $50,000 in work in process, and $85,000 in finished goods. And then we just need to do our income statement. Reminder again, we have, it's a little hidden here behind my screenwriting, but we do have an example of what that income statement would look like if you've totally forgotten the multi-step income statement approach. You can use this snip from the book as a reference. But of course, all income statements start with revenues. And a multi-step income statement, we subtract from that the cost of goods sold to get our gross margin, or what this book refers to as gross profit. For those of you who had me last semester, you know I'm not a big fan of that term. I prefer the term gross margin, and that is much more what you will see in real world applications as well. I don't know why they've chosen to use gross profit. And then we subtract from that our period expenses, so selling and administrative expenses, to get to our bottom line net income or net loss, and I don't know which one it is yet. So we'll just be filling this in with the information we already have. 1.2 million in revenues. That product cost us $675,000. That left $525,000 in gross margin. And because our operating expenses are less than the gross profit, we know we're going to have a net income. I've done my math right. And we now have everything finished. So what I would always recommend is that you hit the check my work button before you move on. It will save your work, but you just want to make sure you have all the green check marks, that you didn't have any math errors or leave anything out. Sometimes if you leave a spot blank, it just ignores it. Sometimes it will actually give you a red X on a blank spot. Sometimes there are spots that are supposed to be left blank. Okay. So we have now seen in the T accounts on the right-hand side for this exercise how the costs flow through. The only piece that we didn't include was the beginning balances, which would be much more realistic, that there would be beginning balances for each one of those three accounts. But I'm sure that you can see how those would be fit in. They would be debit balances to start. And again, you've got the formulas in Blackboard to help you with that, if you don't want to tee it all out. I personally find using T accounts an easy way to just kind of diagram or document what's happening, to think about it. And I would encourage you to use T accounts to see what's happening. But using those formulas that are in Blackboard for this particular part would also get you to the same answer. Just don't think it's as clear what exactly is happening with the ins and outs of the accounts. Questions on this exercise or anything else so far?
Can you scroll down to the bottom? I put in the wrong digit. Yeah, there. Thank you.
So, yeah, so Jamie, these are just the amounts. Show you. So these are just the amounts from here that we already calculated.
Okay. Thank you.
That makes sense then?
Yeah, I put in the complete wrong ones.
Okay. But you see where they're coming from now, right?
Yeah, I see where they're coming from now, yeah.
Plus I got to use those cool arrows. Any other questions before we keep going? Let's move on then. So we've just seen what the income statement looks like. We've seen the basic format. You've reviewed the multi-step income statement. You'll notice that if we look here, that for a manufacturing company, the calculation for cost of goods sold is a little bit more complicated than it is for the merchandising company. Now this looks, if you just look at the income statement part, this looks almost identical to an income statement for a merchandising company. There's one word that's added in a number of places, and that is finished goods, where for a merchandising company, they just refer to it as inventory because they don't have the different types of inventory. So they would just call it merchandise inventory. The other piece that is different is cost of goods manufactured. So if you're a merchandising company, that piece would just be the cost of your purchases. So what did you add to your inventory this month? It's really the same thing for a merchandising company and a manufacturing company. The merchandising company bought it and has to figure out how much they bought. Manufacturing company made it and has to figure out how much they made. The problem is, or what makes it complicated for a manufacturing company, is that cost of goods manufactured isn't something they can just look up on the invoices from their suppliers. Instead, they have this whole extra report down here that is the source of that cost of goods manufactured calculation. So our next exercise is a kind of a piece from that income statement that I just showed you. It's the indented part up here at the top. Finished goods inventory, so beginning balance plus what did we make? What did we add to it this month? So what did we have available to sell? And then how much did we have left at the end of the month? We back into how much we must have sold. We assume, just like for a merchandising company, we assume if we had it at the beginning of the month or purchased it this month, we had it available for sale and we don't still have it at the end of the month, we assume it was sold. We spent a considerable amount of time in class one day during financial accounting talking about the concept of inventory shrinkage, which means we don't have it anymore, but we didn't really sell it. So either it was stolen, it was spoiled, it was misplaced, it was damaged, whatever. Of course, that same thing is true for a manufacturing company, that the inventory that we had might go missing for a number, those same kind of reasons as for a merchandising company. And so that's why it's important that we do the calculation in this order. What did we have available and what do we have left? And if we don't have it still, we assume it was sold. We're backing into this cost of goods sold calculation. If we use a perpetual inventory system, we have a number to use as a comparison because we've been keeping track. Every time we sell something, we remove it from our inventory, add it to cost of goods sold. At the end of the period, though, we're going to do a physical inventory. Hopefully you remember that concept from financial accounting. We do a physical inventory. We actually go out and count it and assign a value to it. And that's what needs to be on our balance sheet as our ending inventory. And that's the number that needs to be used right here to confirm this cost of goods sold number. And manufacturing companies are at least as likely to have inventory shrinkage as a merchandising company. So we need to make sure that our ending balances are what appears on our financial statements, not what we think it should be, but what we actually confirmed by physically counting and calculating the value. This is the last thing that we're going to do today, and I'm actually going to ask you to do this one on your own because we're in good shape at this point to finish up chapter 15 on Tuesday as scheduled. So before I click on this, I see there's something in the chat. I need to remind you, or if you're new to my class, I need to tell you this. If you haven't done a Zoom class, it's the hybrid with students on campus and online. So you all know that in Zoom, you can private chat people so that others can't see what you've said, or you can just post it publicly. I'm pretty sure I did not say on Tuesday because I just didn't think of it, it didn't come up. In the format for this class, you cannot send me a private chat on Zoom. The other students on Zoom cannot see what you put in the chat if you just send it to me. However, there are students sitting in the classroom, as you know, and the only way for me to see your chat is for me to open it publicly. And so anyone sitting in the classroom can see what you wrote, even if you sent it just to me. So I know someone just posted in the chat and I am going to open it. I'm saying this so that you know that you cannot, if you have something personal and private you want to tell me, please just wait. Either tell me before class or send me an email or something like that. You can always wait after class. As you know, I have office hours both before and after class. And so if you just need to talk to me personally, privately, outside of class, what we do is just wait until everyone has left the classroom and everyone else has dropped off the Zoom call, and then we can have a conversation that's private. But whoever just posted in the chat, hopefully you would speak up now if you don't want me to open it. Okay. So I am not able to have a private, the only way I could do that would be to turn off the projector, and it doesn't like to be turned back on. If you turn it off, it thinks it's getting arrested. So our last thing for today is going to be to complete this exercise. I'm going to ask you to do this on your own because it's very much like what we have just been doing. Keep in mind that you're looking for, something that there's just one missing piece, so you can calculate that missing piece, and you'll be able to use the check my work button to check. Reminder from today, we look at the calendar, and so I know that not everyone was here when we talked about this at the beginning of the class today. For some reason, you guys are not seeing everything that's loaded in the calendar. I have to troubleshoot that. But when we look at the calendar, my calendar, you can see that the Chapter 15 pre-quiz should be submitted by the end of the day today. You need to score, as we said on Tuesday, you need to score 60% or higher to get full credit for that. Anything less than 60%, you get no credit. So it's a 1-0, yes, no. You can answer the questions an unlimited amount of times before you hit submit for grading. So please make sure that you continue to work on that quiz until you reach that 60% level. I would encourage you to work on it until you get them all right, because that's the kind of person I am, but you don't get any more credit for getting a 100 than you get credit for getting a 70 on the quiz or a 65 or anything like that. The whole point of the quizzes, as we said on Tuesday, is just to get you thinking about the concepts and preparing for the chapter that we're working on. It's open book, open notes. Feel free to use whatever resource you want on those quizzes. Right, but that's due tonight. And then on Tuesday, we will finish up the rest of chapter 15. I believe we're going to do all the rest of the exercises together, but let me just click through them and make sure I'm right about that. Yeah, so all the rest of the exercises we will complete together. And I would ask you to try exercise 7 with the last few minutes here. Use your check my work. And if you have any questions on it, please just ask. Okay, so it is, so the question in the classroom is about the companion site. And he said it is linked in here, so that's good. So there should be, oh, mine is coming up to the, yeah.
Probably just be the student power.
There it is, yeah, that's what I was looking for. So the ones that are locked are the ones that I have access to, but you guys don't. But yeah, the student PowerPoints here are what I was referring to. And I said, if you like the PowerPoints, if you think they'd be helpful, that's where they are. And there also is a study guide. There are some Excel templates. I can't imagine why you would need to use those when you have access to CNOW, but if you want to. There is a study guide here and solutions to that. Also keep in mind that on the Cengage website, there is, for each of the exams, I do have the practice set of exercises already set up for you. So that might be similar to what's in that study guide. Any other questions before I stop the recording for today? Mm-hmm. Okay, so what you're looking at is the link in the assignments that said chapter 15 reading. Okay, so the question was about, something out of my way. Okay, so the question was in the assignments, and I can't show you what it looks like because mine looks different, but in the assignments, I have all the readings listed there, and you can see that they're not graded. Once you read it, apparently it removes that from the list. I assume it would show up under the all assignments tab still, not just the assignments you can take now. But the other thing you can do is just go to study tools and open the ebook from there. Also at the top of each of the exercises, there's a direct link to the ebook. So once you've read it, it's apparently flagging it as yes, you're done. It takes it off your list of assignments to take. But there are several other ways that you can get to that ebook. I'll mention this again as our first exam approaches, but in particular for people who are new, I will mention when you take the exam, because they are open book, you need to open the book before you open the exam. Because I've been told that if you open the exam, it then blocks you from opening the book. It's intended that you're using the book. So please just, and I'll remind you, please just make sure you open the book before you open the exam so you don't put yourself at a disadvantage. Anything else? All right, well, thank you for being here today. You made it through week one, one down, 14 to go. It's a sunny day out there. I hope you all enjoy your first weekend of the semester, and I will hope to see you on Tuesday.
Hey, Professor.
Yes, sir.